Hi there. Now, the start of this month saw the release of our 2023 long-term capital market assumptions, where we forecast economic growth, inflation, and asset returns over a 10 to 15-year horizon. The combination of higher yields and lower valuations, both of which have materialized in the wake of extreme shifts in the macro landscape this year, now suggests that market offers the best potential long-term returns in more than a decade. Now, in crafting these assumptions, we start with the outlook for economic growth and inflation. Despite the volatile macro backdrop of the past few years, the growth and inflation assumptions have remained largely stable. Inflation risks appear to be more balanced, and as a result of the forecast, as well as our expectation for volatility of inflation, have moved higher. However, inflation expectations remain relatively well anchored, and we expect that central banks will focus on and have the tools to successfully hit the long-term inflation targets. Furthermore, long-term deflationary forces like technology adoption and globalization have slowed but not disappeared. While the macroeconomic backdrop has exhibited stability, expectations for asset returns have markedly improved. The swift normalization of interest rate this year left bonds once again as a plausible source of income and diversification. Higher risk-free rates have also translated to improved credit return forecasts, with spread assumptions remaining relatively stable. On the equity side, current valuations present an attractive entry point, with public equities returning notably higher across the board. And meanwhile, alternatives still offer alpha, inflation protection, and diversification benefits, but manager selection is going to be key. Finally, with the US dollar more overvalued than any time since the 1980s, foreign exchange translation will be a significant component of forecast returns. Overall, this should enhance the long-term appeal of non-US dollar assets. The turmoil of 2022 has brought asset return forecasts close to long-term equilibrium. The 60-40 can once again form the bedrock for portfolios, with alternatives acting as a key complement. Once today's market turbulence clears, investors will have more scope to achieve long-term portfolio return objectives.